Hi, everyone. I'm Kurt Ronig, Professor of Strategic Management here at the Tillman School of Business. In this video, we're going to begin a series of lectures on environmental assessment that has nothing to do with climate change or the weather. Rather, it's about the business environment and how we assess the business environment. And we'll do so in 3 steps, beginning first with the economy and effects that the economy can have on a firm's performance potential. Second, we'll take a look at market forces, and third, the industry structure. The reason that this video and the other 2 in this series are so important is that textbooks on strategic management don't do a terribly good job in covering this very important subject. In particular, if you look at a book on strategic management, just about any textbook at all, you will see attention to the firm's industry. However, you won't see much at all about the other environmental elements, the economy and market forces. You may see a little bit about market forces, but not much, and almost nothing about economic forces. And yet all 3 are very important in understanding a firm's performance potential. If you've looked at my biographical background, you know that I used to be Vice President for Corporate Planning and Development at Phillips Industries. And I also was the first corporate planning director at Holiday Inn very early in its years. Later in my career, I was managing partner of a consulting firm that helped firms all over the world develop their strategic plans and their strategic planning methods. And in all of that experience, I was impressed by 2 things. One was how very important it is to do a comprehensive assessment of a firm's external business environment, as well as the firm's capabilities before making strategic decisions and forming strategic plans. Otherwise, you're making those decisions in a vacuum, and those decisions probably aren't going to be very realistic. Another thing that I learned corresponding to that was that it takes a very long time and a great deal of effort to do good environmental assessment. It requires resources, frankly, it requires money, and it requires talent. Yet the second observation that I made about environmental assessment in strategic planning textbooks and strategic planning courses throughout academics is that not nearly enough attention is paid to it. And frankly, as I mentioned, textbooks and academic curricula in general don't pay very much attention to the impacts of economic assessment and market assessment on strategic decisions, and yet they're so important. So the only thing that I decided that I could do is prepare this series of videos to acquaint you, the student. Hopefully you plan to have a career in business and management, and as a result of that, I assume that you will become involved in strategic planning one way or another. I hope that you will become more involved with strategic planning as a result of this and my other courses. But regardless of the extent of your involvement, you really need to appreciate how strategic planning really happens. And it really happens by taking into account all 3 dimensions of the external environment in making strategic decisions. So with that in mind, I made these videos and I'm now going to share them with you. And with that, I think the best thing to do is to bring up the videos. So pardon me a minute while I try to make this computer do what I want it to, which is not always the case. All right, the other thing I'm going to do is change the lighting a bit here. Okay, so here we are with the first part on economic trends. See if, there we go. And this, pardon me, I'm going to get a drink of water here. This slide simply summarizes what I just told you. That we have to take a look at the entire business environment. And the external environment divides into economy, market, and industry. And then we'll have a fourth video later on how to assess a firm's capabilities. And as I mentioned earlier, textbooks, some more than others, do get into the assessment of capabilities, particularly with the advent of something called the resource-based view of competitive advantage, which we'll get into in this course. But resources, of course, are within the firm, and management, therefore, attempts to improve upon them, to maximize them, and tailor them so that they are well suited to the external environment and able to exploit problems and opportunities in the external environment. So here, if you will, is just a little diagram that portrays what I just said to you, that outside the firm, uncontrollable by management, are these environmental forces. And I've added a fourth force down at the bottom, law, to refer to legal and regulatory forces. And they certainly are outside management's control as well. Within the firm, management's capabilities, which are reflected in the firm's resources and management's skills, are within management's control. And so the challenge of strategic planning really is to develop and organize the firm's resources and skills so that the firm is able to exploit forces in the economy, market, and industry to avoid the problems, the threats, a term sometimes used in strategic management, and exploit the opportunities that can be found in the external environment. But the key here is that when the forces on a firm's performance potential are coming from the environment, management can't control them. Management can control its internal capabilities, and its challenge is to form those capabilities in order to realize the greatest competitive advantage from forces outside the firm, yet uncontrollable. All right, so with that preface, let's get into force number one, the economy. And we're going to begin by looking at the US economy just as a sort of an overview. In this assessment, we'll take a look at all these various items. I don't know that I need to read them all to you. You can do that. But this is a pretty common menu of items of economic analysis that need to be looked at in order to understand what kind of forces are acting on the firm. Later on, in this video, we'll take a look at some unique effects that have occurred recently due to the coronavirus and the impact that it has had on economic trends and economic forces. And from there, we'll take a look at forces in the financial sector per se that can have an effect on the firm's performance potential. I might add that when we get into the early stages of this review, we'll also take a look at the relationship of economic forces domestically to those that are occurring internationally. And I didn't put that on the little menu there, and I should have done that. Anyway, just to refresh your memory for those of you who may not be all that familiar with the structure of the economy, here's a real basic diagram that reminds us that about 2/3 of the economy is comprised of forces in the consumer sector. Now, that's characteristic of the US economy, but not other nations' economies necessarily. In fact, in this diagram, I've made a little note that the effect of exports versus imports is to reduce the size, the accounting for the gross national product by 5 percentage points. If we didn't do that, then the GDP, some 70% of the GDP would be explained by consumer forces, or nearly that size. And I'll explain that on the next slide a little bit more. But as we can see here, even after deducting about 5 points for net exports and net imports, we're left with 65% of GDP accounted for by consumer products. The next largest category happens to be government expenditures, as you can see down at the bottom, with 17%. And that's a really large proportion. And one of the issues that arises very often is just, how much is enough? And how do we control that proportion as government expenditures continue to rise faster than the economy? Then the third largest segment is investment in non-residential structures and projects, everything from office buildings to factories to highways. So there's quite a lot in that 15%. And then 3% more is for residential investment. We separate residential investment out because it's sort of a consumer item also, isn't it? So if we were to add that to the 65, we'd get an even larger consumer segment. So if we want to get a little more detailed, and perhaps you don't, I don't think I want to take very long getting a little more detailed either. But we can see how the personal consumption expenditures or consumer spending turns out to be 70% before the deduction of that net 5% for net exports. And the result of importing more than we export has the effect of reducing the accounted size of gross domestic product, because domestic product is affected by the extent to which we export but it's reduced by the amount that we import because it's not domestic. Anyway, you can see that the personal consumption between goods and services breaks down pretty dramatically, and I hope you are taking note of that. I don't know whether you can see my cursor as a pointer here, but personal consumption of goods represents a quarter of the gross domestic product, which is a big proportion. But 45% is accounted for by services. So increasingly, as the country goes through history, the US economy is becoming much more of a service economy. If we were to go back 100 years or so, we would not see goods and services divided by this proportion at all. Services would be much smaller, and goods would be much more important. But that's where we are today. With regard to business investment, I think that it's important to take a look at non-residential structures, and of course we talked about those when we looked at the prior slide. And imports and exports further down. And then there's the government with its 17%. And a significant portion of the federal portion is dedicated to defense. And one issue there is that the defense expenditures as a proportion of the gross domestic product until Mr. Trump came into office had been declining. And in these days of threat, political threat, international political threat, we sometimes wonder whether it's a good thing that defense is accounting for less of our government expenditures, even though it looks like a large proportion in this table. We need to protect the country in order to protect our industry and our way of life. In any event, the other item that's interesting down at the very bottom of this table, what do you think? The largest portion of government expenditures for goods and services is at the state and local level, not the federal level. Out of the 17% accounted for by government expenditures, 10 of that 17 is at the state and local level, not the federal level. Okay, the purpose of this little review was simply to get everybody familiar with basic terminology and frames of reference. Now we'll get into the real thing. So we'll begin with global economic trends. And this is the thing that I mentioned to you a couple minutes ago. My little menu of the scope really doesn't pay enough attention to the fact that this first part deals with global economic trends. And I apologize for that. Frankly, I just realized it as I was making this video, so I didn't have a chance to fix the slide. But here we see long-term trends in GDP of the United States, Europe, and China. And I hope you're noticing that there has been a major change in a couple respects. First of all, you can see that China's economy surpassed that of Europe and the United States in the mid-2000s or 2010s. In earlier presentations like this one that I've done, the data that I had received from the International Monetary Fund had China surpassing the United States in 2013 and the European Union in 2014. More recent data have pushed that closer to the present, so that now those dates are somewhere around 2016, 2017, thereabout. But certainly by 2018 and 19, we can see that China's economy has pulled away from Europe and the United States. We can also see something really dramatic in this slide, can't we? We can see that the US and European economies declined in 2020 due to the coronavirus pandemic. But that China's economy, it slowed down to only about a 2% growth, but it continued to grow. So while our economy declined a bit, perhaps 2%, maybe more, the numbers are still coming in, and the fourth quarter is going to be very important. But no doubt about it, the economy of the US declined. And as you can see, the European economy has declined even more sharply. And we'll see more slides that bring this fact into the light even more brightly as we proceed through these slides. But what you can notice is that the distance between the red line and the black and blue lines widens over time. So the Chinese economy is larger and it's growing faster than Europe and the United States economies. Another rather interesting statistical observation is that back at the beginning of this century in 2000, China's economy was 36% smaller than the European and American economies, which at that time were just about equal in size. But when we look to the International Monetary Fund's forecast for 2025, and it's unlikely that this forecast will be very far off. We can see that China will have pulled ahead by 39%, just about as much as it was behind at the beginning of the century. So over the first quarter of this century, China has completely eclipsed, reversed its position in the world with regard to the size of its economy and comparable economies. And this is something that we need to think about and frankly worry about. So here we see the same numbers for some other countries, and the one on the top that always draws attention is India. You can see that India's economy is growing faster than the others on this slide. It's not nearly the size of the ones we just looked at. If we take a look today in 2020, we see a number a little less than 9 trillion. So if I go back and look at China's, we see about maybe 24 trillion. For the US, just about 21 trillion, and significantly less than that for Europe. But if the US economy were $20 trillion, then that would be twice India's, or more than twice India's, at about 9 trillion. In 2019, it was up to 10 trillion. But you can see that India's economy has really dropped in the pandemic, and currently The coronavirus is very widespread in India. And for that reason, I'm not sure that the IMF forecast will turn out to be true in this case. The coronavirus is having a very severe effect on India's economy, and the IMF certainly has picked that up in its current data. I'm just skeptical of its forecast in this case. The another item on this slide is the one right below India, the brown line. That's for the Asean nations, ASEAN, the Association of Southeast Asian Nations. There are 10 nations in that group. 4 probably are more important, not probably, certainly are more important than others, and perhaps a 5th. The 4 that I was thinking of are the Philippines, Indonesia, Malaysia, and Vietnam. Those are all pretty substantial economies, and they're all growing pretty fast. Singapore is a city nation, so it's not nearly as large, but it's a very important nation in Southeast Asia for a variety of reasons that I won't bore you with now. The ASEAN nations tend to behave together. They're pretty tightly knit. And so we can think of those as a similar unit as we think of the European Union. The red line is interesting. That's Russia. And you can see that Russia's economy is not all that strong. I have to look at the line here, but let me guess it's about $4 trillion. And that's when we do a currency conversion. And again, remember the US is 20. So Russia's economy is not so large. The other thing you can see is that it's not growing very rapidly either. So Russia is a threat. It's a very real threat because it's a thermonuclear power. But as an economic adversary, as an economic rival, it's to be taken seriously, and it has been, and we'll get into that later too. But in terms of actual aggregate numbers, both the economy and the size of its population, about 144 million compared to about 235 million in the United States, and a 1.4 billion in China, and nearly the same in India. So Russia is important because of the threat that it poses militarily, but economically not the same. Rather interesting little item that I pulled from The Economist recently, just to remind us that although we're suffering a lot under the pandemic, countries in Europe have suffered more than we have. This bar chart shows the decline in gross domestic product in the second quarter when the pandemic came roaring onto the scene. It began in the first quarter, but late in the first quarter. So the second quarter is the first one where we can see the full effect. And you can see that countries like Spain and Britain, and today Britain even more, because it's suffered what seems to be the emergence of a variation on the coronavirus, a mutation, a new strain, and it's causing a great deal of economic damage in Britain as well as other countries in and outside of Europe. So here are the rates of change of these countries we've been talking about. You can see over on the left, China continues to have the higher rate of change than the other major nations. It did suffer a decline this year. But notice that the decline in the red line does not press below zero. It comes close, it gets down to about 2%. But the lines, the green and the black line are the US. And you can see that the declines in the US economy and the European economy were quite severe, and especially so in Europe. And Europe is still struggling, whereas the US is beginning to make some strides to dig its way out. Over on the right side, we can see that all the countries in that graph dipped below zero in the second quarter. We can also see that the IMF contemplates that India will resume a fast rate of growth, as it did. If you can see the purple line before the recent decline, India has been enjoying some atypical rapid growth. Here in the black line, we see the Asean nations. So those are the two lines and the two groups of second tier economies that have especially rapid growth potential. And if we look at these growth potentials here, we can see 5, 7, 8%. And that's with the exception of China, that's larger than anticipated growth of the US and India. So the growth action is over here on the right side of the chart for sure. And again, we need to bear in mind that India is, and we will see pretty soon that India's economy is greatly troubled today by the pandemic and by a number of internal difficulties, whereas ASEAN nations are growing and they're able to enjoy higher living standards than in India. So you need to, I think that business folks who do strategic planning for Asia need to pay more attention to the ASEAN group, because there's a lot going on there. Here is the other side of the coin. If we take these GDPs that we just looked at and divide them by their populations, we get completely different answers. The highest in GDP per capita is an indication, among other things, of wealth and consumption potential. And so if GDP per capita is high, you can expect more consumption. You can expect, frankly, higher living standards, generally speaking. This is a very general measure, and we don't want to get too carried away with it. But you can see that the highest line on the left side now is the United States. The United States is the wealthiest nation in the world, and will continue to be so. Europe as a whole, and here again, we're averaging 28 countries in Europe. They're about the same size as states in the U.S., but again, I'm not doing a good thing when I say that. Some European countries are smaller than most of the states in the U.S., but others are larger. So this is a very crude average that we're looking at. Nevertheless, we can see that that average is also significantly higher than GDP per capita in China. So the Chinese economy and the Chinese people are less equipped to enjoy luxuries. Now, we need to be careful about that as well, because the Chinese economy could be divided probably in thirds, between the folks who are truly laborers and unskilled, the middle folks who have education, and more people in China are educated and earn a salary, and they consume products and services, and then a small portion in China, perhaps, and I'm just guessing here, but maybe 20% are fairly well off. Now, 20% of 1,400,000,000, that's 280 million, isn't it? And the U.S. economy, the U.S. population in total is 325 million. So, and about 280 million of those are consumers. So the consumer economy of China and the consumer economy of the United States, when you're talking about the sorts of goods and services that you and I are used to, are about the same. I don't know if you're aware of this, but the largest automobile producing nation in the world, the nation that buys far more cars than any other country in the world, is China, not the United States. So we need to be careful when we look at averages like these. Nevertheless, these averages do give us some perspective on which nations need to be dealt with from the standpoint, perhaps, of pricing as well as quality. The kinds of considerations that we make in marketing in the United States and Europe are not the same as those that we'll always make in China. And we may need to pay attention to that. Now, over on the right side, we see another surprise, and that is that the GDP per capita of Russia is rising fairly rapidly, and more rapidly certainly than India. India, as you can see, is quite small, but Russia's is moving on up there. Nevertheless, when we take a look at the rate today, it's what, about $27,000 when we do the currency translation. And if we find $27,000 over on the left side, we're about where the European Union begins that line. So Russia's got a way to go, but it's going. Now, once again, you have to be really careful with these numbers. One reason that Russia's GDP per capita is growing is that its population is not growing. In fact, last year and this year, Russia's population actually declined slightly. And so it certainly wasn't growing like the US population is growing. So if the economy grows and the population doesn't, then the GDP per capita of Russia has to grow. Is that a good thing or a bad thing? And it really depends on your point of view. If what you're trying to do in Russia is provide more for the people that are there, and you can do that, then maybe that's okay. But in fact, what drives Russia's economy isn't always consumer goods and services, but rather other things, which we'll get into later. It's a very military economy. Here we see unemployment rates. And once again, oh, I didn't mention, and let me just do it real quickly, but you can see that the GDP per capita of India is very low. So although it's rising, it's a large population, just about the same population as China. And although its economy is growing, it's going to be a long time before consumers in India can buy the kind of things that consumers in China can buy, let alone those in Europe and the United States. Great big economy, great big population, a lesser economy, and a much poorer population. Okay. And lo and behold, when we see this chart of unemployment rates, where do we see unemployment the highest and projected to continue on for a while? It's India. Uh, Incidentally, the blue line is Europe and the black line is the United States. And Europe has had persistently high unemployment in recent years. These are not good rates. And the IMF anticipates Europe's unemployment rate to stay relatively high. And at least for the current year, we know that the US unemployment rate at about 6.7% when last measured is uncomfortably high and higher than it has been recently, although it did reach that level previously during the big financial industry crash and the recession that occurred during 2009 and 10. Okay, here are consumer prices, and frankly, not too much problem. What we see is that over the past decade, consumer prices have come down. Some difficulties perhaps in the European Union and India. So even though India's people can't afford to buy as much as you and I can, when they do, they sometimes find that the prices for what they need have gone up certainly faster than their incomes. This point is 6.7%. So last year in 2019, consumer prices in India went up by 6.7%. So is that right? Did I get that right? 6.7%. But even in India, we see now that because demand has really crashed as a result of the pandemic and for some other reasons, which we'll get into in this course, consumer prices are not rising as they have in the past. If you want to see high consumer price increases, this red line is Russia. The point that I'm at right now is 18%. That was 2001. Here we are in 2008 at 13%. Even as recently as 2015, 13%. So Russia has its problems, not the least of which are sanctions that have been placed on Russia by Europe and the United States because Russia invaded and annexed the Crimea and invaded the Ukraine. The European Union put sanctions on Russia for that, and the U.S. Has been a leading adversary of Russia, and very quickly placed sanctions on Russia as well. Incidentally, here we are with the consumer prices in India again. In this case, 10.5% in 2012. Times are tough in India. Here's another indicator that you really should pay attention to. This chart will change soon, but this is the proportion of GDP represented by national debt, gross national debt. So it includes debt between the Treasury and the Federal Reserve. There's a lot of intra-governmental debt in these numbers, but debt held by the public also is included. And you can see that this year, at the most recent reading, gross national debt was equal to 130% of the gross domestic product. Ladies and gentlemen, that is a big number. Not only that, but we're about to see Congress pass another coronavirus relief bill. And it will provide money to you and me and to businesses and industries that have been hurt by the pandemic. The problem is that when it does that, and we'll get into this shortly, what we see is a large increase in the amount of dollars, the amount of money that is in circulation or not. It may just sit in banks, and we'll see that too. But what that does is lessen the value of those dollars relative to their GDP. The GDP, the number of cars, the number of chairs and desks, whatever else you can think of that are produced will be the same, even though the number of dollars goes up. And so what happens is that the value of each of those dollars goes down as more dollars go up, and the physical amount, the actual amount of goods and services don't go up, at least don't go up as fast as the amount of currency. And that presents serious problems. The other problem that is presented here is the difficulty that the government is going to have in getting this debt back down to where it used to be. You can see if you follow the black line to the left that it's been, below 100% since 2000, I guess 2018 anyway. And back here at the beginning at the turn of the century, it was less than half the current rate, something like, what does it say, 53%. So we've seen a rapid escalation in the national debt, and that is going to put pressure on a lot of industries that we might not want to put pressure on, including healthcare, Medicare, Social Security, defense. So if the government's busy paying back debt and paying interest on debt, then it doesn't have as much to meet those other requirements. So here then we've got, let's see, the US, this one is Brazil, boy, it's up there. And here we see China, and China at one point was down at the level of some 23%, and most recently it's been at, see if I can pick off a number for you, 62%. So over time, China is using borrowed money as well. Now, in China's case, that's not such a bad thing. There are numerous reasons. One is that it holds, I'm not sure, but I think it's something like $3 trillion of US obligations. It buys US federal debt. England buys more. Secondly, in the world finance markets, debt is very cheap. Interest rates are quite low. I think we'll see that in another slide. So it's easy for the Russians to finance their growth with cheap debt. It's also easy for the US to do that, but you get to a point where it becomes difficult to repay the debt, number one. Secondly, if interest rates should rise, right now they're quite low, but if they rise, the interest payment obligation, the debt service obligations would become much higher in most of these countries, except the one down at the bottom, and that's Russia. So you can see that Russia has debt that is very low as a percent of GDP. It's less than 15%. Okay, there's one other item we want to look at before we move on, and that's the so-called gross national saving rate. It's not something that the folks look at often, but it should be. It's the sum of corporate profits and personal savings. And so it's essentially a measure of liquid capital that is available to invest internally, for instance, in infrastructure. So when we're asking how will economies grow their way out of the current recession that most are in, we'd like to know what their ability to make investment in infrastructure is, because that's often a very good way out of a recession. One, it employs people, and two, it builds the capability of the economy to function more efficiently. And where do we find the highest rates of gross national saving? You guessed it, it's China. And you can see that it's substantially higher than that blue line on the bottom, which is the US. Even India has focused until recently on extraordinary investment in infrastructure, but that rate has come down in recent years because of the difficulties that India is having with its economy. Even China's gross national saving rate has come down, but you can see it's something like 45% today, which is really something. So China has the ability, as does India, and the brown line, by the way, is Russia, and you can see it's climbed up there a bit. So we can see that the Russians are trying to make more investment to build their economy by building infrastructure, and it's abundantly obvious in China that that's what's going on. They say in China that the crane, you know, the thing that is used to lift steel and equipment up into a structure that's being constructed. They say in China that the crane is the national bird. I don't know whether those of you who know me know that I travel internationally quite a bit. Sadly, I could not this summer because of the coronavirus, but a couple of years ago, I was traveling throughout Russia, and the year prior to that, I was traveling all over China, and everywhere I went, I saw construction. The only way to understand China is to go there, but it is a nation under construction, as well as a nation under great social change. So here is the saving rate, gross national saving rate for some other countries and groups. And what's that red line? It's the Asean nations, isn't it? Now, it's today, it's, what is it? The thing's not going to tell me. I must have copied it and pasted it here. But it looks to be about 30%. So if we come back here, 30% would be about where India and Russia are. So ASEAN is certainly no greater. I mean, this looks sort of like China, but it's not. It's more like where India and Russia are. But that's a pretty high rate. 30% is getting right along. And so we can expect that there's quite a market for building materials, construction equipment, contractors, and so forth, in these nations that have high rates of gross national saving. Down here at the bottom, sub-Saharan Africa, and not too interested in that. We see that the rate is increasing in Europe. That's encouraging, but it's still not what we would call a high rate yet. Here it is in Western Europe. When we look at Germany, we see the highest rate, Italy, the lowest. Once again, I'm a traveler, and Spain and Italy are both suffering. I love to go to both of those countries, and I speak, read, write French, which I use in my international travels because the Europeans are multilingual. And you know, the saving rates in Europe, Southern Europe especially, are not very high, and that's because their economies are so strained that it's difficult to break funds free for construction purposes. And this is this graph is very believable, and the reason I say that is that when I look at the green line at the bottom and see that Italy's rate is so low, I remember my travels in Italy. I love to go to Italy. Well, I don't want to go there right now. It's covered with coronavirus, but they're historians. They're not contractors. So let's now take a look at trade balances. That's after I drink some coffee to bathe my throat. And here we see something that we've heard President Trump talk about a lot. So I think you're probably, just if you watch the news, you're familiar with this picture, even though you may not be familiar with the graph. And that is that Russia and China have enjoyed high trade surpluses for different reasons. China's surplus has been because it's been able to produce goods and some services, but products less expensively. Its labor costs are lower, but also its mechanization. Again, you have to go to China to see just how well many companies are set up for manufacturing. So China has been a supplier of the world. Russia, on the other hand, is not that efficient, but it has lots of petroleum, lots of oil and gas, and it has been the primary supplier of energy to the rest of Europe. However, we are now in a state of competition between Russia and Saudi Arabia, and lo and behold, the US is producing more natural gas than it can consume, and it is therefore liquefying it and shipping it across the ocean to Europe as well. So we can see that that red line is declining, and that's because Russia's surplus of petroleum exports has been declining, but it's still a pretty significant surplus. It's as of 2018, it was what, maybe 7% of GDP, dropped down in this year because of the reduction in demand. But there's another issue in this chart, and it's what President Trump complains about. You can see the black dotted line, right? That's way below zero, and that's a deficit in the balance between imports and exports, the trade deficit. And the US runs a trade deficit, sometimes a very serious one. This is almost 6% of GDP here in 2006. But over time, we've been getting a handle on it. And by 2017, it was only about less than 2%. And you can see that the IMF forecasts that it'll stay in the range of 2%. But it's still a deficit, isn't it? As opposed to up here, the European Union with a surplus of almost 3%. And you can see that over time, the European Union has and remember, that's a collection of 28 countries, but those countries as a whole have exported more than they've imported. And of course, the expectation is for Russia to continue to be to have a trade surplus, as well as China. So the US is on the wrong side of this ledger. This is an issue that US governments, whether they're Republican or Democrat, are just going to have to deal with, because that deficit has an impact on the value of our currency. Here are some trends, simply some trends. On the left, we see the actual trade balance. On the right, the trade balance is a percent of GDP. So we've got two visions of, or two views of the same issue. So the first one is China. And as you know, they've run a very strong trade surplus. But over time, the Chinese government has undertaken to focus on domestic consumption rather than exports. China is trying to become more self-sufficient, less dependent on trade with the United States and Europe, and more dependent on itself. And so we see that whether it's in the aggregate or as a percent of GDP, the trade balance is positive, but not nearly as significant proportionately as it has been in the past. Here we see the same thing in India. And this is, as you know now, India's been running a deficit, and the International Monetary Fund anticipates that this deficit is going to get a lot worse, because India is going to need, among other things, petroleum and lots of other goods and services to maintain growth. But because the economy is growing, even though this deficit's getting larger, proportionate to the GDP, it's hanging in there at about the same rate of maybe 2.5%. The top lines here are Russia's trade balances. You can see that they've been bouncing all over the place, and as a proportion of its GDP, they're currently pretty high, at about 6%. So Russia depends economically on those energy exports. And to the extent that it's in competition with Saudi Arabia and now the United States, There are some other pipelines under construction from Northern Europe that threaten Russia's trade balance. So Russia's got its problems. The European Union has for several years run a positive trade balance. It looks like a big one, but when we look at the graph over here, you always need to look at the y-axis to check the size of the numbers. And right now it's about 2%, and the IMF contemplates it dropping to 1.5% of GDP. This is what's been going on with the United States. And as you can see, it's negative across the board. Now, in class, we talk about this a bit more. If we were to break this down between goods and services, we would see that our deficit in the purchases of goods, as opposed to selling goods to our trading partners, is even worse. The deficit is more than this. But we sell services, investment banking, insurance, commercial banking, a whole lot of services to our trading partners. I made a tiny little contribution to that when I took my consulting services to Europe. So a little stress. But if we did that, we would see that the line is positive, that we have a positive trade balance in services. And so, the one possibility for the US government is to try to develop more in the way of services provision to our trading partners in order to bring this line up, because it's uncomfortable to see a trade deficit of this magnitude. So we've taken a look at the international or the global perspective. Now we can take a look at the US with a particular focus on what's been happening as a result of the coronavirus. And here you can see the impact of the coronavirus on the US economy in the first and second quarters of the current year, 2020. And I'm not sure, let's see if I can pick this number off, but it's something, as I recall, the drop was about 34% in the second quarter. Ladies and gentlemen, that is just devastating for a country's economy to drop by a third. Here are a number of indicators of what's been going on, they point out some anomalies. First of all, with the coronavirus, why would weekly earnings, median real earnings, that is with inflation taken out, why would they spike like this? And the reason is that the people who earn the least, the hourly folks, the folks who work in restaurants and hotels, are unemployed. And so the ones who are left over earn a higher hourly rate. And so because we've got fewer low-wage earners, the average wage goes up. This is a beautiful illustration of how statistics and graphs can give very misleading I guess misleading information, but they can fool you. Here it looks like, the U.S. wages are going up dramatically. And in fact, they're not. All the folks who are making, or many of the folks who are making low wages no longer are in the statistics. Another thing that's happened is that the government, as we mentioned earlier, has been doling out quite a lot of money and is about to, as I make this recording, as I record this video, the US Congress is attempting to pass and expected to pass another bill which will provide a distribution of more funds to families who need it and industries that need it. But in the process, when people get this money, they don't all need it right away. Some folks need it immediately and spend it, and it's still not enough because they're unemployed. Others who are employed do what with that money? They put it in the bank. They don't spend it. And so you can see that the saving rate, which is what's left over between disposable personal income and personal consumption expenditures, income less expenses, divided by the income is the saving rate. And you can see that it was going down, then it came up, and then boom, up it went. And it increased some 25%, or 26 to be more precise. And that simply is an indication that when that money was distributed, it was not spent. And that brings to mind a real question, which is, are these programs doing what we want them to do? And the answer that we usually get is, we don't know, but we don't have any better way that is politically acceptable to distribute that money. Look what happened during the early stages of the pandemic, and mortgage delinquencies shot up and stayed up for a while and then worked their way down as things got under control or partial control again. You can see that delinquencies are still higher than average and have begun to start back up again. And I think we're going to see these delinquencies rise as we move into 2021. Anyway, another interesting way to look at it, at the effects of the pandemic, is households' net worth, simply their assets less their liabilities. And when the pandemic occurred and people became unemployed, the value of their tangible assets, including their home, although home prices have come back up, but the folks' net worth dropped very sharply by about $10 billion in that one quarter. Here's what's been going on in employment, and we're going to look at this from a couple of perspectives besides these charts, which I pulled from another source just because they're based upon people who are old enough to be in the workforce, 16 years or older. That's, but in any event, you can see what happened to the unemployment rate. It got up just about to 15%. It's come down. Most recently, the official unemployment rate was 6.7%, so it's come down further. But the unemployment rate is lower, but still uncomfortably high. However, the unemployment rate among or the proportion of folks who are of employment age has been relatively high in recent years. It's come down as the economy has gotten stronger and then shot back up so that we're starting all over again. The reason that's interesting is that you have to wonder whether this is the rate at which unemployment is going to decline from this point. If it is, then it's going to be a while before we see 5% unemployment. All right, now the real issue. Unemployment basically is based on sampling. It's based upon registration at the unemployment office, requests for Social Security or unemployment benefits and so forth. And it's not a perfect number. Another way to look at this same issue is to ask what portion of people who are old enough to be employed, in fact, are employed. And what we see here is a big difference. We see that in the second quarter, when things got their worst, only slightly more than half of the employable people in the United States, in fact, were employed, and more recently, 55%. But folks, that's not a very large proportion, is it? And I think that you need to take this number into account when you try to understand why, for instance, wage rates are not as high as they are, and why they haven't grown in recent years. And I think this is one reason. You can see that even when things were really moving along, we were only at about 60%. Got up to about 62%. That was good. But now here we are back down at 55%. Another way to look at this is to look at you. You're going to have a bachelor's degree and you're going to go out to the workforce. This is the portion of the workforce with a bachelor's degree who are 25 years or older. So they're all in the workforce. There's no excuse. They're not. Some may still be in school and graduate school, but they're going beyond a master's degree. And you can see that when the pandemic hit, it really hit. It really hit those of us who have who have at least a bachelor's degree. Here, the labor force utilization rate was less than 75%, maybe about 73%, something like that. And now it's down to maybe 71, 72%. So quite low, and it took quite a significant drop, you can see, when the pandemic hit. And another thing that we see is that it doesn't look like that employment rate is recovering much. And most recently, and this is the most recent chart available from the Federal Reserve Economic Database. That's what FRED means, Federal Reserve Economic Database. And so this is the government's most recent data as of Christmas, just right at Christmas. So it hasn't recovered since the pandemic has been with us. This is a measure of how you and I feel about our economic situation. There are lots of technical ways to discuss it, but it's a survey done by the University of Michigan. It's highly reliable, widely used. And as you can see, when the pandemic hit, oh boy, our attitude shifted from increasing to lower, a lot lower. This is a major decline. We'll see how things progress as we go forward. You can see that it looks like things have begun to get better, but not much. And we're concerned about a second wave of the pandemic. We're concerned about a mutation of the coronavirus. And we're also concerned about the federal deficit and how difficult it's going to be for the government to keep pouring money into the economy, and how difficult it will be for you and me to spend it. And so exactly what happens to our attitudes and our confidence to the extent, pardon me just a minute, I've got a problem with my unit here, and I'll be right back. That happened because my feet got tangled in the cord that attaches the camera to my computer. I'm sorry. So anyway, this is one measure of attitudes, and those attitudes of consumers have a great deal to say about the potential for consumer spending. Let's see, I'm gonna have to give this thing a little, there we go. This is another measure of the same sort. It's done by the Conference Board in New York, and it's also widely used. It measures much more specifically our confidence, your confidence, and my confidence in our economic prospects, employment, earnings, that sort of thing. And you can see that as of August, it had dropped really sharply. And although it tried to come back up in the month after in the quarter after the pandemic hit, it did not succeed and fell back down again. So what we see is a dramatic change. I mean, ladies and gentlemen, let's just take a quick look at where we've been here. Here's unemployment, and more importantly, the employment ratio. It's been hit. Here is the participation rate, which is comparable to the employment rate, right? This is the portion of people who have college degrees and are 25 years or older who are employed. So is it a surprise that our sentiment and our confidence has been impacted? No, it's not a surprise. But to the extent that this is the case, then we have an issue with regard to, among other things, what kind of spending people are likely to do, how willing they are going to be to buy products that take some time to pay for, whether they're willing to buy new cars, new homes, take vacations, travel, so forth. So very quickly, here's the trend in consumer spending of the United States. You can see it dropped significantly, came back a bit. Here is that saving rate that we looked at earlier where it jumped up 24%. This is the same chart we saw earlier, and you could see that what we have here is people, some people, not spending the money that they received from the government. Others, on the other hand, were unemployed. They needed that money, but even that was not enough. So consumption went down. Um, Another thing that happened was that people were less able to make payments on their debt. And so debt service payments as a percent of DPI also have come down. Now, that was going on before the pandemic. We had a big drop, as you can see in this chart, when the last big recession, the financial meltdown occurred. And when that happened, lots of mortgages, lots of debts were foreclosed. People couldn't pay them and went into bankruptcy. And the result was that lots and lots and lots of people no longer were paying on their debts because they, as I said, declared bankruptcy or the banks had foreclosed. The result was not so much debt payment anymore because the debts had been wiped off the slate. So what really matters is what's going on down here. And we can see, let me just sort of do a little artwork here. See if I can even make it classy. Okay, so there we go. It's in what's inside this circle that's of most interest to us and most importance. And we can, you have to sort of squint your eyes a little bit, but you can see that since, I don't know, maybe 2013, it still has come down. And then when the coronavirus hit, that was sort of the coup de grace. Our ability to make debt service payments has really been reduced. So something's going on in the US economy financially. How many people borrow money to buy a car as opposed to lease a car? That's reflected. Okay, so here we are with new orders for durable goods, such as cars, furniture, appliances, and so forth. And you can see that when the pandemic hit, boy, it really dropped things steeply. But what is amazing is that thanks to the government's programs, we've had a recovery. The durability of that recovery is an issue, but this is this is the Federal Reserve data, so it's very recent. And you can see that right now, the new orders for durable goods have picked up again. Construction spending has been one of the areas that has not suffered in the pandemic. It did initially, but then you can see that the line turns up and keeps going up. Once again, there's a question of just what's going on here and how long that will last, especially given those numbers that we looked at regarding consumer sentiment. But as we're all aware, the United States is under a great deal of internal strife, social unrest. And as a result, residents of cities are moving out of some cities into suburban and essentially rural areas to get out of the city and away from the violence that is occurring in those cities. And allegedly, that's the reason for construction spending, residential construction spending, that is paying money to buy a house. There are mixed opinions about this. And so I don't want you to take what I've just said as an absolute conclusion. We certainly know that residential construction has come up. Another reason for that is that interest rates are much lower than they have been in the past. So if ever there were a good time to get a mortgage and buy a house, this is it, because interest rates are so low. So whether or not this line is due just to people wanting to get out of the city, as opposed to the fact that houses are now a good buy because interest rates are low, that's being debated right now by economists. And I don't think the final verdict is in yet. But I suppose it's a combination of the two. We're going to take a look now at some financial indicators. This is what I was just talking about. This is what's been happening to the prime rate. That's the interest rate that banks charge businesses that have preferred financial conditions, good credit ratings. And the prime rate is down in the neighborhood of 3.5%, something like that. Here are some other interest rates, and you can see that they've all come down pretty dramatically. My headline still says fourth quarter. I guess in one case here, we're right at the end of the fourth quarter, December 17th. But this is the mortgage rate that I was talking about. And it's now down, it's no longer over 3%, it's 2.7%, which is the average 30-year mortgage. So again, if you want to buy a house, you know, a big part of your monthly payment always is the interest in that mortgage. And with interest rates this low, buying houses is more attractive. Here is the note that the Treasury pays on a 10-year note. And this isn't as good a news as it looks. My mom and dad, when they were retired, were able to retire by buying bonds from companies, corporations, and the government, and they got 6 or 7% interest on those bonds. Today, a 10-year note will get you 1%. So folks who are retired, your mom and dad, your grandparents, whoever they might be, who are trying to retire on fixed income, they're having a heck of a time because they just can't get adequate interest payments to earn enough to pay their bills. It's a big problem, but there's so much money out there and there's so little demand for it today, especially, that the interest rates are quite low. You can see that in this one chart, the Treasury note fell below 1%. Here we have Moody's high quality corporate bonds. Moody's is a credit rating agency. A AAA corporate bond is highly rated. And you can see that it's more than, you can get paid more than Treasury note. You can get 2.3%, but again, that's not too good. Up here, when times were really flowing, it was 4%, which is almost enough for retirees, but not quite enough. But that's about as good as it got. And so if this explains, among other things, what's been going on in the stock market, there's really not much of an opportunity to invest in bonds and make an adequate income. You have to take greater risk by investing in the stock market. So here's that mortgage rate, and over here we have corporate bonds of less quality than those AAA bonds, and they're down to 3.2%. So there's just so much money available that and so little demand for it that the borrowers can offer a relatively low rate. See how low these rates are? And sell that paper, even when the risk is a little higher. So this is a serious issue in the U.S. economy. Now, I just borrowed this graphic from something. I think it was the Federal Reserve, but it was an article, and it simply indicates that the proportion of debt to GDP is rising. I showed you that in another chart. So this is more in the nature of a comment. You can see that when this article was written, it said that the government debt to GDP is expected to reach 120% by the end of this year. Well, it's 130% now, and that's before the government issues another round of something like another $1 trillion, and proposals are for a parallel funding bill, so it could be $2 trillion. The result will be, I don't know, perhaps 135%, 140, whatever it is, it's too much. It's too much. It's backbreaking, and it's damaging the value of the currency. So here's a little exercise, and this was done at mid-year, and I just copied it because I must have used it for a class or something, but I just wanted to share it with you. You can see that the money supply, the amount of money in circulation in June was 21 trillion, which was greater than the GDP. Today, that number is, gosh, what is it, 23 trillion or something like that. Anyway, the prior quarter, just 3 months earlier, it was 17.3. So $3.7 trillion was added in one quarter. That's 21%. The GDP is not growing at 21%, is it? But the amount of money in circulation was. In 1981, the GDP was 3.5 times the size of the money supply. But by the second quarter of this year, the GDP was less than 1 time the size of the money supply. So money flowed through the economy. The velocity of money was 3.5 times. The money flowed through the economy 3.5 times a year, annualized. But at least I didn't say that very well. In the third quarter, money was flowing through the economy 3.5 times annualized. Here in the second quarter of this year, it didn't quite flow through the economy 1 time. And now that we've had this most recent round of stimulus bills, far less than 1 time. So I'll have to redo these charts, but I think that you can get the idea here. And that is that money is not moving through the economy as rapidly. It's backing up, and that's having impacts on interest rates, as we saw earlier. And it's probably not a very healthy thing. So here, by the way, are some rates that you and I can use to purchase foreign currencies. So when I was in China a couple of years ago, I think I was getting something like what was it, about 6.7 yuan to the dollar. And you can see that that the dollar after that bought even more yuan. But as a result of what we've just gone through, we can see that now the dollar buys fewer units of Chinese currency. That means that you and I have to pay more dollars to buy the same amount of Chinese goods and services that we might have bought 3 or 6 months ago. And this trend is probably going to continue. The average exchange rate of the US dollar to foreign currency has dropped pretty precipitously. Here it is in Canada, here it is in Mexico. So purchases of foreign goods and services, commodities that'll perhaps then be used in processed foods and finished food products are going to cost more. And if they're going to cost more, then you and I are going to have to pay more for the products that are made from those commodities when we go to the grocery store. So let's see if we can draw some conclusions. Now here I need to warn you, these are taken from a paper that I wrote, and it's just got a lot of bullet points in it. So sort of turn off the computer for a couple minutes, rest your eyes, go to the bathroom. But I'll go through this as quick as I can. I think there are 4 slides with these conclusions, but they've got lots of bullets in them, and I'm sorry for that. But here we go. See what I mean? So one thing that you can note from the charts we've looked at is that long before the pandemic arose, some major changes were happening in the US economy and the world economy. For instance, the shift in the relationship between the Chinese economy and the US economy. That was going on before COVID. The same for India and so forth. So we need to take into consideration that the COVID pandemic has accelerated some of those changes and added new ones, imposed hardships on millions of people. But we need to see this thing as part of a process that didn't begin and end and won't end with the coronavirus. So all of the economies except China contracted this year. All the major economies did. And China continued to grow at a slower rate, but it did grow. Many of the economists whose work you read expect a so-called V-shaped recovery. And when we looked at several graphs, we saw a V-shaped recovery, a quick recovery after that second quarter. But that's not true of all industries. And in some countries, it's not true. Latin America, Africa, Europe, they're not enjoying, they're not going to enjoy a V-shaped recovery. Partly that's because the coronavirus pandemic is much worse. Also, they're simply, their economies are not as strong as the US economy. China's economy today is the global leader. There's just no question about that. We don't like to say it, because China is our adversary, but it's larger, it's growing faster than the economies of Europe and America. That's a fact. So as business people, we need to deal with facts. We can't get wound up in emotion. And if you want to be part, if you want to have a growing enterprise, and you're in a global industry, then you really ought to be doing business in China if you can. The problem is that there are tensions between China and the U.S. For that reason, you can see the next bullet down. China's planners are focusing on reducing trade dependence with the United States and becoming more independent. We'll get back to that bullet. But to go back up, why are these tensions occurring? Well, there is frankly just a natural conflict between the US and Russia. Each one wants to have geopolitical power. And in the past, the US has been a sort of a standalone global power, uncontested. Now China has contested that power, and in many respects has equaled the US power. Another reason for the tension is the trade surplus that China has enjoyed, and that among others, that has infuriated Donald Trump. We would certainly like to have a better trade balance with China. Of course, there's this other issue, and that is the coronavirus began in China, and for reasons that could have been avoided, the coronavirus spread throughout the world and reached the United States, and that came to us from China, and we resent that. That is simply the situation we're in now, that there is a great deal of tension between the two countries. So China's planners plan to reduce dependence on the US. They're going to grow by encouraging domestic consumption. They're going to build their consumer sector. They're going to also build their technology industry. But that's going to take a while. And they also, China needs US agricultural products. Very recently here, the US shipped a whole lot of wheat and oats and soybeans to China. So whether China likes it or not, it's going to have to do business with the United States. And whether the US likes it or not, it's going to have to do business with China. So the tensions will be high, but the trade will continue. It'll just be more difficult. India, fastest growing of the developing economies, population about the same size as China's, 1.4 billion people. China's is on record at 1.35 or something like that. And by 2023, China's population will exceed, India's population will exceed China's. But India's economy is troubled. And it'll be a while until the potential of India's economy can be realized. So for now, China's economy provides growth markets for the present. China is the growth market of the present. India is the growth market of the future, but it's going to be a while before that potential is realized because of all the difficulties that exist in China and India today. Here's another really busy page, and I'm very sorry. I'll try to, I think the best thing to do is just look at the underlining, and I'll try to summarize as best I can. So for the near term, India offers minimal opportunities for the reasons that I explained. Its infrastructure isn't well developed, regulations are burdensome at best, there's political corruption, and the coronavirus is widespread, which is really bringing down the economy. Western Europe's economy also has been hit very hard by the coronavirus, and I hope you've already recognized that in the news. It's much harder than either China or the US. Very severe in the UK, France, Italy, and Spain. And the problem in dealing with the problem is that the members of the European Union don't always get along too well. The countries, oversimplifying and taking a great deal of license, countries in the north tend not to agree with countries in the south. So Spain, Greece, Italy, among other things, they've got real economic difficulties. And as part of the European Union, they'd like to have help from the European Union the same way that states in the United States, when they have calamities or difficulties, can look to the federal government for help. The European Union is not quite that way. It's a confederation, it's not a republic. And so the northern countries, Germany, Holland, England, they don't see things quite the same way as Spain, Italy, and Greece. Now, there are 28 countries in the EU, and I've just mentioned 6 of them. So again, I'm grossly oversimplifying. However, the point is that the countries in the EU are having difficulty coming together to agree on solutions for their economic difficulties, and now even the coronavirus, although there's been much more consensus on the coronavirus than basic economic issues. China's economy is certainly the largest, but as I mentioned earlier, it's not the wealthiest. That distinction still belongs to the United States. Russia's GDP per capita has been increasing, but as we noted earlier, part of that is due to the fact that the population isn't growing. So if the economy grows, then the GDP per capita does grow. But that does mean that it's possible for the Russian populace to enjoy some increases in living standards, assuming that those economic benefits flow into the population rather than restricted industries, which is somewhat the case. Unemployment rates throughout the world are high, very high, and they're highest in India. They're persistently high in Europe, and they're even unacceptably high in the United States. What makes it more difficult is that the way in which the US is going to solve its employment problem is not the way that can be dealt with in Europe for reasons I just explained. And certainly India is a completely different proposition. So much that I'm not even going to begin to dip my finger into that, because it would untangle a can of worms. India's economic situation is highly complicated. So there are some countries, as we noticed earlier, that have relatively high gross national saving rates. Remember the sum of personal saving and corporate profits, right? And so we found that China, India, and Russia all have relatively high gross national saving rates. And so we can expect them to try to deal with their problems by making investment in public buildings, highways and roadways, which is very desirable in India because Until they improve their roadways and highway system, it's going to be difficult to transport goods and services throughout the nation. And trade account balances are part of the overall equation here, particularly to the extent that they affect the value of nations' currencies. China, Russia, and European Union have enjoyed sustained surpluses. The US has suffered from a sustained deficit. So then we took a look at US economic trends and observed that the coronavirus has imposed severe penalties on the United States, but with massive government spending, which is still going on, there is an impending recovery in some but not all sectors. So a V-shaped recovery is occurring in those sectors that are recovering, but the results are actually mixed, and the so-called V-shape is a gross oversimplification. I don't think it's even accurate. So unemployment rate is high. More importantly, the employment rate is low, much lower than it has been. And with only 55% of the eligible population working, that means that there is, it's going to be very difficult, among other things, to see wage rates rising. And it's going to be difficult to see the majority of our people enjoying significant increases in living standards. Households' net worth dropped sharply in this year. Even mortgage delinquencies shot up for a while to over 11%. Federal relief payments continue have been very high at mid-year, and they're about to flow again. The problem is that not all consumers need those gifts, I guess, the disbursements of funds. Many do, and those that do are unemployed, and the amount that they receive is probably not enough. But those that do receive the payments, I'm trying to dredge the word up from my mind, and I'm having difficulty doing it, but the recovery payments, who don't need them are simply putting them in the bank. So the US saving rate at one point was actually 24% of disposable income. Nevertheless, with all of this money flowing into the economy, the money supply is inflating, and eventually that inflation of the money supply may become exactly what I just called it, inflation. Certainly, you know, we have plenty of indication that that's a possibility. The velocity of money has dropped from 3.5 times to 1 time. There certainly is plenty of money available to make purchases. So in that respect, there's plenty of pent-up demand. And we see some of that reflected in low interest rates and purchases of new homes. That's good. But with lower demand for funding, higher money supply, interest rates are historically low. The prospect of higher interest rates is is what is troublesome in all of this. Most experts don't think that rates are going to rise. If you look at well-regarded, well-respected economic forecasts, they do not anticipate interest rates or inflation rates to rise very fast. But inflation refers to inflation of the money supply relative to the amount of goods and services that are provided by the economy. And we have seen that the money supply has grown much faster than the economy. And so if, as a result of those basic mechanics, inflation and interest rates do increase, then the federal government, with this large amount of debt that it has created, will be hard pressed to service that debt. And the result could be impingements on essential expenditures, such as education, Medicare, and defense. So that's an issue that has to be dealt with. And I'll talk about that in just a minute again, to try to understand what the ramifications are. Today, by the way, because of all that we've talked about, a US dollar buys less of foreign nations' currencies than it did a year ago. And the result is that it'll cost us more to buy commodities from other countries, and those costs will flow into prices that you and I pay for products that are made from those commodities when we go to the grocery store. Finally, the computer did me a favor. It made the bullet a little bit smaller. Do you see the dot is smaller than the one above it? But I don't know that it should be smaller. I think it might actually, it should be larger. Something else is going on as a result of the coronavirus pandemic and its impacts. And the necessity of foreign controls. I'm sorry, not foreign. The necessity of social controls on your behavior and my behavior, whether it's wearing face masks, social distancing, staying at home, not traveling, closings of restaurants, the way we have to operate our classes by remote video service, such as this one. All of that has induced a state of malaise, discontent, unhappiness, frustration. And so when we looked at the Conference Board survey of consumer confidence and the University of Michigan survey of consumer sentiment, we saw drastic declines. And we feel that we have felt that during this year's Christmas season. I hope you had a nice Christmas with your family. One of my good friends is going to visit his parents. When they leave their parents' house, another set of in-laws will come to visit, and then another, and so forth. But they didn't want to bring the whole family together for fear of creating, if anybody has been confronted with or exposed to the coronavirus, then if the whole family met, everybody in the family would get it. So they decided to do it one family at a time to reduce the risk of exposure. All of these little phenomena, not little, some of them are pretty large, but all of this together has created an attitude problem in the United States. And it's going to have effects that I certainly cannot measure. I can't tell you what they're going to be. I just know they're there and that they are having a significant economic impact and a significant impact on business. We've talked about some of them, such as the ability of people to buy homes on the one hand, and yet their inability to travel or to incur the expense of buying consumer products, even when they have the money. So this takes us then to the so whats. What are the 5 strategic issues? And I just sort of devised 5 issues from all that we've talked about. And these are issues that business planners, chief executives need to have to take into considerations as they form their strategic plans. When we get into parts 2 and 3 of the environmental assessment, when we look into market trends and industry trends, there will be some more strategic issues, but here are 5 for the present. First of all, the recovery from the coronavirus timing is not going to be the same in other countries as it is in the United States. In some parts of the world, it'll be quite delayed, even with the vaccines. Getting the vaccine to people in some countries will be difficult, quite difficult. The effectiveness of the vaccines in those countries, the ability of countries to control health conditions, all of these things are going to make it a real difficult proposition to see a uniform recovery from the coronavirus. So even if the US enjoys a rapid recovery, and we certainly hope that will be the case, our trading partners will not all enjoy rapid recovery. That's true in Europe. It's true in undeveloped countries in Latin America and Africa, and certainly India, where until recently we've had a lot of trade. So what will be the result? The result is that this notion of globalization is going to reverse. It's already been reversing. Like I said, some of these trends occurred before the coronavirus began, the pandemic began. But now that it's here, globalization is shrinking, and instead regionalization, doing business either at home or closer to home, where it's easier to get the goods and services that we need. Dependence on sole sources, and less likely. Rather have supplies from two different parts of the region so that we can obtain the materials that we need to make our products and so forth, even if health conditions or other conditions prevent those parts, those materials from getting to our factory from one location. We'll hopefully have another source closer to home than in the past that we can draw upon. The result will be higher cost, but hopefully continued operations. So I think that's pretty much the point, that we're going to be dealing with recoveries of nations that are not consistent, but different and very difficult to predict, very unreliable. So it's going to make doing business much more difficult, much harder to do production and manufacturing planning when we can't be confident of where our raw materials and components are coming from. Second, our country will not recover from this pandemic easily. And it's not because we won't be able to solve the healthcare issues. The vaccine looks like it's going to get the job done, at least temporarily until we're confronted with a mutation or something else. But rather, we've got this huge federal debt, which is going to exceed 130% of GDP. When I prepared these slides, it was 130%, but we know it's going up. So how do you get it back down is the question. How do you get that federal debt back down below 100% of GDP? And it should be lower than that. Will we raise taxes? Will the government raise taxes in order to pay down that debt? That's possible. And we hear some politicians talking about that. Another possibility is to really cut government expenditures. I can tell you as a senior citizen, I don't want them to cut Social Security. Although I still am employed and I don't need Medicare as much as my friends and neighbors who are my age, they don't want Medicare and Medicaid to be cut either. So nevertheless, that's one possibility. What really frightens me is the possibility of reducing defense expenditures, because we're in a very unfriendly world right now. And we need to strengthen our defense, in my opinion. But it's possible that all those types of expenditures could be reduced so that we can do what? Repay debt. Or we can do something that allows inflation to go up. And in fact, we're already doing that, aren't we, with these massive injections of funds into the economy, disbursements, recovery payments of trillions of dollars. And because there are more of those dollars, the growth of those dollars exceeds the growth of the economy, then on the average, dollars per unit produced will go up over time. Dollars per unit, that's price, isn't it? That's how we calculate price. So again, the general thinking in the economic world is that that's not going to happen, but it certainly could. And there is some writing about that possibility now. Simply allowing inflation to go up and hold off on repaying that federal debt. As the economy grows and inflation goes up, we're able to pay down the debt simply from normal taxes and probably somewhat higher taxes. But over the long term, the debt will come down, the GDP will go up, debt as a percent of GDP will fall. But that's if we take a longer term perspective. Another possibility is to do some mechanics in the federal federal accounting. A lot of the money supply expansion that has occurred from Federal Reserve buying U.S. government bonds and injecting by paying for those bonds, putting money into circulation. Now the government has to pay those bonds. Maybe it won't. Maybe it won't pay them when the time comes. And although that's possible, that raises some very difficult problems. And all that I read says that it will be it's unlikely that that option will be chosen. So if it's unlikely that taxpayers will accept severe increases to retire federal debt by asking you and me to pay more in our taxes. If it's not likely that severe reductions in expenditures for Social Security, education, defense, Medicare, so forth, the senior citizens won't like that. And seniors are becoming a very large proportion of the population, and they're more likely to vote than you are. Seniors vote in larger proportions than younger people do. And so the politicians know that if they reduce expenditures for those particular items, that there will be a backlash at the voting booth. So what does that leave us with? One option, and that is allowing inflation rates to increase while the economy grows and the value of those debts becomes lower in real terms as inflation proceeds. Allowing inflation to go up makes the real value of those debts go down. And so, although we don't expect inflation and interest rates to rise, it seems to me that there are some reasons to be concerned about that possibility. And I don't think those reasons are trivial. And then we have the issue of some industries simply taking longer to recover. Some industries are growing rapidly, but others, airlines, aircraft manufacturers, heavy machinery manufacturers, restaurants, even local banks, they're really struggling. And those industry struggles are going to continue for quite some time. They're not seeing a V-shaped recovery. And yet, some industries have flourished. And I think you know about them. I also noticed that my camera's a little off here, so I'm just going to adjust it. But semiconductor industry, social media, healthcare, pharmaceuticals for sure, vaccine manufacturers, some industries are doing quite well. And here finally, the last slide, hooray. And it'll take us less to discuss these items too, less time. But something else that we have to draw, another conclusion that we have to draw from what we've already seen, is the fact that economic and military power is flowing from the east to the west. The largest and fastest growing economies in the world are China, India, and the Asean group, especially China. The slowest growing economies of the world are the US, European Union, which is growing much more slowly than the US, Latin America. Of course, I could throw in others in Africa and so forth, but you get the picture. Now, there's a funny corollary between economic growth and military growth, and military power, I should say. And that is, with economic growth comes military power, because the ability to produce military equipment and technology increases as well. So we're in a new world here. We're not in a world that is dominated by the United States and or Europe any longer. Those days are over. China is a real serious competitor here, a real rival. And as we go into the future, we have to ask ourselves just what's going to happen in India. But we're going to be in a world where the US is not going to be able to call all the shots, even though we would prefer to have it the way it was. It's not going to be the way it was any longer. And so as business planners, as strategic planners, we have to take that into account. Russia is a strange situation. I was in Russia a couple of years ago, traveled through quite a lot of Russia. Fascinating place. The people are good people. At least I thought they were. You know, maybe I was only able to meet the good ones. But it's not wealthy like the United States is. But they have big cities, Moscow, St. Petersburg, to name two. But they have large cities, and in those cities, there's a developed economy. Russia is certainly a major military power because it has nuclear and thermonuclear capability. It's bigger than the United States and Europe and China. It's over 6.5 million square meters. The US is about 3.8 million square meters and China 3.7. So I'm sorry, square miles. So meters, my God, that wouldn't be very big at all. Square miles. So if you will, Russia is about twice as large in its land mass than the United States. Please don't send me notes about not knowing the difference between meters and miles. I really do. When you get old, you get a little daft. And I didn't read my own notes here adequately. I just saw the M and read meters. Anyway, the population of Russia is relatively small. It's about 144 million compared to 335 million in the United States. So it's not even half the size of the US in population, and it's a billion smaller than China's population. So in terms of population, not nearly as large. In terms of the value of its economy, if we do a currency translation and use purchasing power parity, Russia's economy is about $4 trillion. That's about a fifth of the US economy at about 21 trillion. And it's a sixth of China's at 24 trillion. So Russia is not big in population. It's not big in its economy. It is huge in its land mass, and it's scary in its military capabilities. And what makes it scarier is this tension that exists between Russia and the Western world. It's not just the US, but Russia invaded the Crimea and the Ukraine a few years ago, and the result was a condemnation and economic sanctions, that is, economic penalties, refusal to buy or sell goods to Russia, sanctions even on their bank accounts in Western countries. And the result has been a real impact on Russia's economy. And Russia resents that, of course. Now, you've got some very complicated issues here. Crimea is the most difficult to understand because about 85% of its population, as I understand it, is Russian. And so most of the citizens of the Crimea prefer to be part of Russia. But that's not how the rest of Europe saw it. And the US was quick to jump in and impose sanctions for the Russia's occupation of the Crimea. The Ukraine is another matter. The Ukraine has sought more relations with Europe, the European Union, and Russia has been in the habit of dominating Ukraine, and so it's invaded. And there, I think the the condemnations are more appropriate. But Russia is the neighbor of the Ukraine and expects, because of its greater economic and military power, to have substantial influence over the Ukraine, which was at one time part of the Soviet Union. The US has Mexico as a neighbor and Canada as a neighbor. We sort of expect that Mexico and Canada will respond to our political wishes because we have greater economic and military power. It's not exactly the same, but it's not completely dissimilar either. So yet, while these problems exist, it's going to be very difficult to resolve these tensions between Russia, the European Union, and the United States. And as long as those tensions exist, there will be military risk involved. To make matters worse, the coronavirus has now spread in Russia, and it's very serious, and they're having a hard time getting a hold of it. The final issue, the final strategic issue, is simply food for thought. I shouldn't say food for thought, considering what I'm about to say. But a funny thing about the coronavirus is that, and there's begun to be some writing about this, although this issue has not been contemplated until just recently during the pandemic. But the issue is this: the coronavirus has visited terrible damage on the United States as well as many other countries. And it wasn't difficult to get it into this country at all. And if you wanted to do it again, how difficult would it be? A virus in a vial, in a container, being carried across a border somewhere is about all it takes. It's not expensive. It's not physically difficult. So compared to the kind of warfare that we've been planning for in years gone by and still must plan for, germ warfare, as it's called, biological warfare is cheap and easy and horribly effective. We've walked into a new age of military contests, of military conflict and military planning to defend, to detect and defend against biological warfare is extremely difficult, and it's going to have to be the highest priority for our defense planning and programming right away in the immediate future, because we now know just how devastating biological warfare can be. And if you were to pretend, I don't think this is true, by the way, but if you were to imagine that the coronavirus was allowed out into the world at large rather than just the United States by China, then you could say that this coronavirus pandemic was an extremely effective demonstration of biological warfare. I think this pandemic occurred because of some very sloppy handling in China and by global agencies, non-public organizations, non-governmental organizations. Nevertheless, we now have the evidence in front of us. Biological warfare is the #1 priority for defense as we go forward. So I don't know how long this has been going on, but it certainly has been a long time. And I'm sorry, and I hope you were smart enough to mute or to stop the recording and go take a break and go to the bathroom and get a cup of coffee. But we've covered some very important material in these slides. All of these slides are on your Moodle shell, so you can review them at your leisure. It'll take a lot less time to review the PowerPoint slides than it has been to listen to me. I'm sorry for that. But as I mentioned at the very beginning of this video, a problem that we have in the strategic planning community is that our strategic planning, strategic management textbooks simply don't deal with these kinds of issues adequately. And so I have to do it this way. And with that, you can see that the Christmas tree is shining behind me. As I make this video, it's the Christmas season. When you look at it, the Christmas season will be over. So I can't wish you a Merry Christmas because that's past. But I can tell you that I hope that you had a very happy holiday and that this will be an enjoyable, if not laborious, course for you. And with that, I will try now to end this recording. Goodbye.